Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Chris Englebert, founding partner and chief investment officer of Englebert Investment Advisors, to discuss how RIAs are leveraging AI. Chris, it's great to see you as always. Welcome back to Trade Talks. And before we get into what everybody cares about AI, I want to talk about the three things that investors are worried about right now.
Yeah, Jill, it's really amazing. Every time we do this, there's something different that comes to the forefront. But really what everybody's worried about now is they're worried about banks, earnings, and the impending recession. And, obviously banks have been in the news, but I'm seeing something I've never seen before. We've been buying, short-term bank CDs for clients because they're yielding 5%. They're well under the FDIC limits of $250,000, but I'm getting clients calling up concerned that they have 50,000 in a bank CD and what that means to them. And, we have to patiently explain the FDIC insurance and how it works. And, I remember back during the global financial crisis, you had banks going under and, the CDs were paid off literally within a week to 10 days. So, that's one of the things. The other thing that people are really trying to figure out is why is the stock market going up if we're going to be in a recession? And I keep pointing out to them that in the fourth quarter of last year, 2022, many analysts came out, they lowered earnings expectations because of the recession. And now here we are in Q1, and these earnings, they're good. They haven't fallen off the cliff yet. So we're still seeing increases in sales. And that's why the market's floating up to what we believe is the higher end of the range right now.
So, Chris, let's talk about the topic du jour. Of course, it's becoming part of the consumer vernacular. How are registered investment advisors leveraging artificial intelligence known as AI?
Yeah, I'm super excited about this because I really think, once again, when there's leap forwards in technology about every 10 to 15 years, it really helps, for example, small businesses, RIAs, we're able to handle more clients. And I'll give you a couple examples. So the first example is we use a product called Levitate to send out our emails to our clients. And we were on a call with them a couple of weeks ago, and they showed, we can go in, we can write up our own email, but they have an AI-powered email generation system where if you want to say something about required minimum distributions, you put in the word required minimum distribution, hit the little AI icon, and boom, you get a letter with all the information on what a required minimum distribution is, what you have to do, et cetera. So it really is going to make us a lot more efficient, rather than spending that 20, 30 minutes writing something, now we literally can, I hate to say press a button, but press a button. The other company we're working with is a company called QDEC, and we've been working with them for over a year now. And the two areas that they're really offering is number one, creation of investment models. So in the old days, you kind of put an investment model together, we'd use some software. Well, now we can use machine learning and back testing to create those models that eventually we invest our clients' money in. And then the third thing, which I think is also going to be huge, is news and information. So, I'll get a client call me up and says, hey, what's going on with Apple stock today? And, you got to scan the news headlines, may take you a couple of minutes, et cetera. The same company, QDEC, has created a portal where I can literally type in what's up with Apple today, and all of the footnoted news items will come up so I can see what was said on CNBC, what was said on Bloomberg, et cetera. So again, efficiencies of scale, being able to get information faster, it's really exciting time for the next step as far as registered investment advisors go.
Sorry, I was muted by accident, but Chris, I'm glad that you brought those examples up because, a lot of concerns that we hear is, are these techniques going to take away our jobs? Will humans be gone? And the feedback that I've been getting is actually, it will make jobs more efficient. For example, we've had lawyers on, we've had doctors on, and they are leveraging chat AI. And I'm like, it's first, second, third year associates as a young doctor, don't you have to kind of break yourself in going through contracts and looking for the idiosyncrasies in such dense language and research? And it was pretty overwhelming that they said, this will take time away from those mundane tasks where they can go and think about more creative solutions, more complex research. So it kind of, it's going along with what you're saying as well, where if you write a press release, do you have to spend that much time on it when you can kind of, make it more formulaic and think about more creative strategies and solutions? So I think it's good to talk about that and let people know, no, it's not taking away your jobs. It's going to enhance it and let you work on more complex scenarios. And it sounds, that's how you're embracing it.
Yeah, I agree completely because again, you hit the nail on the head. I mean, there's some stuff like, for example, RIAs hate marketing. It's like, oh, it's a necessary evil. We got to get out there. We got to send out emails, whatever. Well, if I can spend 5 minutes, a week on marketing instead of 50 minutes, well, you've just added more, time to your bottom line. But you're exactly right, because what I'm finding out with the use of AI, I hate to say this, but it's like the old adage when computers first came out, garbage in, garbage out. It's just kind of the same thing with AI. If you don't know some of the basic premises or, what you're trying to achieve, and you're asking, AI, that's still in its infancy. It can't make the second, third, or even fourth derivative problem solving. Now, will it get there? Yeah, probably. But again, I'm looking at it from the standpoint that it's just making me more efficient overall.
Right. And then, of course, you want your brand to have a voice, and you will insert that brand as you go through what's been spit out from ChatGPT or Bard, and insert your brand from a communications perspective. So we'll continue to talk about that, Chris. I think it's super exciting. I agree with you there. But let's take a look at the charts. You had spoken about the S&P 500 briefly before, and you think that we might start to, move a little bit higher here. But from a technical perspective, what are you seeing with the S&P 500?
Yeah, again, my thesis this year is that we're in a structurally fair market. We're rallying to the top of the trading range. I mean, I hate to say it, there's been a huge stick save, by large cap growth for the markets, but there has been. I mean, we are reconstituting our models right now, and our models, I mean, it's obvious that core large cap stocks are leading the charge this year. Again, they've been able to execute something very similar to 2020. When the pandemic first hit, the large companies were able to execute, expand, increase sales. Well, the same thing's happening here in front of the recession. Large companies are able to cut, people a lot quicker, bring dollars to the bottom line. I really think, that's what investors are looking at this point.
Well, speaking of mega cap, large cap, let's take a look at the Nasdaq 100. Clearly had a tough year in 2022, but, has been leading the way for this year for sure.
Yeah, there's no question. It's got all the relative strength. Again, everybody keeps screaming that, there's fewer and fewer stocks, leading the party. But again, if those stocks are doing well, sales are up and earnings are good, that's what's going to draw investors to them. And that's where the money is flowing right now.
It's also, speaking of flowing in, not really going into the Russell 2000.
Yeah. Now, one of the things that people have to understand is the Russell 2000 has a lot of small regional banks in it. So you're seeing that effect on the Russell. And so it's really acting as an anchor or a drag. But the other thing that's also happening out there from a valuation standpoint, the Russell compared to the S&P or compared to mega cap stocks is at one of the 3 largest differences we've ever seen. So again, my thesis is you buy what's cheap and sell what's expensive. Investors have to look at rotating some money sometime into the small mid-cap area.
And let's take a look at oil.
Yeah, so my thesis is coming true that inflation pressures are beginning to ease, and I go back to the chart of oil because it's an easy way to explain. But we could see in areas of the country this summer gasoline under $3 a gallon. But again, there's a lot of products that are made with oil. And when oil was going on the upside, there was inflationary pressures there. But we're also seeing other commodities, wheat, soybeans, corn, have all come down tremendously, which should help in those inflation numbers that the Fed is watching so closely, showing that in the first half of 2023, inflation looks like it's beginning to ease and actually ease rather rapidly.
And finally, let's wrap up and take a look at the 10-year.
Yeah, the 10-year Treasury, we've been saying this for a couple of months now. We think it's pegged around the 3.5%. We actually think the bond market's working again this year. And what we mean by that is that when the banks first sold off, you saw a flight to safety. Everybody ran to the 10-year Treasury. Yields dropped below 3.5%. And then when everybody was like, hey, it's time to get back in the water, yields floated up. But we see the 10-year pegged right around 3.5%. That was our call at the beginning of the year, that we thought the 10-year would be plus or minus 50 basis points around 3.5%. And that's where it seems to be right now, even with the Fed raising short-term rates.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.